Imagine waking up tomorrow, opening your banking app, and seeing a notification that says withdrawals are temporarily limited due to liquidity conditions. Not because you overspent, not because you did anything wrong, but because your bank does not have enough cash available right now. In today's digital world, money does not move in lines outside branches. It moves in seconds. One headline, one rumor, one viral post, and billions of dollars can leave a bank before lunch. That is not fear. That is the reality of modern liquidity risk. Welcome to U.S. Finance Insights, where we break down money, markets, and future trends in a simple and practical way. If you value clear, calm financial analysis without hype, take a moment to like this video and subscribe. It helps the channel grow and tells me you want deeper insights into how the system really works. Now, let's break this down step by step. Most people believe banks simply store their money in a vault, but that is not how banking works. When you deposit $1,000, the bank keeps a portion in reserves and uses the rest to issue loans, fund mortgages, buy bonds, and finance businesses. Your deposit becomes part of a larger financial engine. That system works smoothly under one condition. People withdraw money gradually and predictably. The risk begins when withdrawals become sudden and concentrated. This is what liquidity risk actually means. It does not mean the bank is bankrupt. It means the bank may not have enough immediate cash on hand to meet a surge of withdrawals at the same time. Even a financially healthy bank can face short-term pressure if too many depositors move their funds at once. Banking runs on confidence, and confidence can shift quickly. Think about how fast information spreads today. A report surfaces about unrealized losses on bank balance sheets. Social media amplifies it. Influential investors comment on it. Large depositors quietly move their funds as a precaution. Others notice and follow. Within hours, billions can leave digitally. There are no long physical lines. The line exists inside mobile apps. Speed is the new risk factor. Here is where many savers misunderstand the system. They assume their money is either completely safe or completely at risk. The truth is more structured than that. In the United States, deposit insurance protects insured deposits up to a specific limit per depositor, per bank. If a bank fails, insured funds within that limit are protected. That protection exists for a reason. It is designed to maintain confidence and stability. But here's the key distinction. Insurance protects against bank failure. It does not prevent short-term volatility, temporary stress events, or rapid digital outflows. Liquidity stress can still occur even in a regulated and insured system. That does not mean collapse, it means pressure. Now let's add another layer. Rising interest rates change the liquidity landscape. When rates increase, the market value of older bonds declines. Many banks hold long-term bonds on their balance sheets. On paper, those assets may still be sound if held to maturity. But if deposits suddenly leave and banks are forced to sell those bonds quickly, losses can become realized. Liquidity pressure can turn into solvency concerns if selling becomes aggressive. There's another subtle trigger most people ignore. When banks offer very low interest on deposits, while money market funds offer significantly higher yields, funds begin to migrate. At first, slowly. Savers move excess cash, seeking better returns. But if outflows accelerate, liquidity tightens. The issue is not profitability alone. It is funding stability. Not all banks are exposed equally. Large, diversified institutions typically have broader funding sources, stronger capital cushions, and access to multiple liquidity channels. Smaller regional banks may depend more heavily on concentrated deposit bases. If a large percentage of their deposits come from a similar customer group or industry, risk becomes more concentrated. Concentration increases vulnerability during stress events. So, what does this actually mean for you as an American saver? It means preparation is more powerful than panic. The first step is understanding how much of your deposits fall within insured limits. If your balances exceed those limits at a single institution, spreading funds across multiple banks can reduce exposure. This is not fear-based behavior. It is structured risk management. Second, treat banking relationships the same way you treat investments. Diversification matters. Relying on a single access point for all liquidity creates dependency. Maintaining access to more than one institution or account adds resilience. Even if one channel experiences delays, you are not financially frozen. Third, build a personal liquidity buffer. Ask yourself a practical question. If digital transfers were delayed for 3 days, could you cover essential expenses without stress? That buffer does not need to be extreme. It needs to be intentional. Short-term access to funds provides long-term emotional stability. Now zoom out to the bigger picture. When central banks tighten monetary policy to control inflation, liquidity across the financial system contracts. Less liquidity increases market volatility. Higher volatility increases uncertainty. Uncertainty increases withdrawals. This creates a feedback loop. However, the system also has stabilizing mechanisms. Policymakers can provide emergency lending facilities and temporary liquidity programs designed to calm markets during stress. The modern financial system has built-in shock absorbers. But here is the deeper insight. Banking stress in the future is likely to be faster and more digital than in the past. It will not look like old black and white images of people standing outside branches. It will look like rapid balance changes inside apps. The speed of reaction has increased dramatically, and speed changes everything. The real risk for most savers is not total system collapse. The real risk is being unprepared during temporary instability. If you understand insurance limits, diversify access, and maintain a liquidity buffer, you reduce your personal exposure significantly. You move from reactive to strategic. Preparation changes psychology. When headlines turn negative, prepared individuals remain calm. They do not rush to make emotional decisions. They do not amplify fear. They observe, evaluate, and act based on structure rather than noise. In financial systems, emotional discipline is a competitive advantage. So here's the question you should seriously consider. If your primary bank faced a temporary withdrawal delay next week, would you feel confident or anxious? Your answer reveals your level of preparation. Let me know in the comments how you structure your savings. And if this breakdown helped you see the banking system more clearly, share this video with someone who values financial stability. Because awareness reduces vulnerability, structure reduces fear, and smart preparation turns uncertainty into manageable risk. This is U.S. Finance Insights, reminding you that smart money decisions today can change your tomorrow.